May 29th, 2024. I actually mentioned yesterday in my video that every once in a while, once, maybe twice a month, more like once a month probably, you get a day where there just really isn't a good swing and everything just kind of goes sideways and the daily range is small and it stays that way. It looked like it was possible that we were going to get that yesterday when we had a really tight range for most of the beginning of the day, but instead we got that day today. Um, the market is going to be relatively sideways. You can see on the daily chart, the bears or the bulls who bought here were disappointed in this and they sold, and that's what caused this. Am I interested in selling down here? Not really. I think that there's probably going to be buyers at the moving average, and we're probably not going to collapse through it. I think most likely we're going to get a bounce back up into this, tight trading range that we're forming at the top. That's probably some sort of final flag for the bulls. But today was one of those days where there really just wasn't anything great for a swing for stop order traders. Most of the day just spent time in a trading range. And if you look, 90% of days break out either above the high of the 18 bar range or below the low of the 18 bar range. And you can see today, we tried to break out of the high a couple of times, but we weren't quite able to. And actually, on the very last bar of the day, we went one tick below the low. So traders selling here, the target they knew was the bottom of the day because we were yet to break out of the 18 bar range. So it's really interesting when that happens because the target is the low of the day, and everybody's trying to get there. But a lot of traders get trapped out by bars like 78, which makes sense. But you can see we touched that low of the day during bar 81. Bar one, a bear bar, but really not all that ideal. Whenever you get a big gap down, I think immediately you should be looking at the prior day's low. So this to me is the biggest hint when you get a big gap down. If we end up getting some sort of rally and it fails to get to the prior day's low and we get a reversal down, that increases the chances of a bear trend day since it's an open gap. And if we rally and we get to the prior day's low, it decreases the chances of a bear trend day because now the bears have to do even more versus when they have the big gap down, most traders are already pretty much on the bears side and they think that, okay, well, the bears just have to provide some proof that they're strong. And instead, and usually that proof is don't let it get to the prior day's low. And instead today, we got back to that point. So that was disappointing for the bears and made me think that we were probably going to be more sideways to up for the rest of the day. And instead of up, we were just sideways. Bar one, a bear bar, but a big tail on both sides. Really not a very good bar to sell below, but I'm not really interested in buying below that bar either. It's technically follow through for the gap for the bears, but I mean, look at it. It's really not all that great. Buyers below, you can see. So bar two, a bull bar, a bull body, but a tail on the top and a tail on the bottom. What am I looking to do anything here? Not really. I think, probably always in short from the gap, but it's really not all that great for either side. Three, a bear bar closing near its low. Bears see a double top with one, but it's a tight trading range. Probably more buyers below the two low than there are sellers. So again, I would rather wait. And then bar four, you can see we found buyers below three and we got a reversal up. Probably just testing back into the tight trading range. It's double bottom 2 and 4, but I'm not really sure this is going to be the start of the big bull trend. It was the start of what was the best move of the day. When you get good follow through on 5, you have to ask yourself when you're looking at 4, is that the type of bar that starts a big bull trend? The answer is probably not. So you get the good follow through on bar 5, which is what the bulls wanted, but big tails on 4, so really not all that ideal. I think the bulls need one more bar after 5 to convince me that we're probably always in long. Everyone knows that the magnet is the low of yesterday. So, some traders buying above here, they don't quite have 1-to-1, and traders want to look to buy closer to the 1-to-1. So traders might look to buy a pullback of bar 6 or bar 5 instead of directly above it. Bar 6, a bear bar closing somewhat near its low. Am I selling below bar 6? It's a possible bull trap, 4-5, and a possible high of the day, but we're not very close to the moving average. So I don't think it's all that great to sell bar 6 after consecutive really strong bull bars 4 and 5. To me, it seems like we're going to be more sideways. An outside bar, bar 7, you can see buyers below 6, sellers above. But again, I'm just going to wait. I don't think anything here is all that good. 8, you can see we overlapped with the 1 low, so it closes that gap. We should get back to the 4 high. You can see we got within 1 tick of it over here. That's actually exactly where we found all of these buyers causing the big outside up bar on bar 11. So a lot of that was due to bears who sold above this that scaled in higher, and they were looking to get out, and that's a lot of what caused bar 11. But anyways, 8 triggers below 7. It wasn't a very good, you could argue low too short on the open below 6, bad follow through 7. Traders are using 8 to exit. So bears want it to be a double top 6, 8, and they want to swing down. But bulls just see a really big bull bar 5 and two-legged bull back 6, 8. I think the bull argument is reasonable. I don't think we're going far if we trade below the double top, probably just to here. But overall, this looks more like a leg in a trading range to me than it does any sort of bull trend. Bar 9, a bull bar, but again, a tail on the top. And look where you're buying if you're buying up here. You're buying in the middle of this tight trading range. This is one of those situations where it feels like everybody knows that we're going to get here, but sometimes you kind of just have to let it go without you. I wouldn't buy above 9. I think you're buying too high in a tight trading range, and I'd just rather wait and see what happens. And instead, you get disappointing follow through on bar 10. And if you noticed, during the first couple minutes of bar 11, we sold off really heavily and traded below, the bar 8 low, which is probably where a lot of bull stops were. So trapping out traders with tight stops and rewarding traders who scaled in there instead. Reversal up on 12 or on 11. 11's a really big reversal up. We're probably going higher. And again, I'm expecting us to get to yesterday's low at this point. That is the premise of the trade, buying above 11. And you can see traders were able to make a 5-point scalp pretty much exactly. And if you look, all the good trades today pretty much just went for 5-point scalps. Even 60 was probably reasonable. And they made exactly a 5-point scalp. There just was not a lot of good trades today. But when you're starting to see this much trading range price action, I think a lot of traders are just going to look to make 5 points and then exit, make 5 points, exit, make 5 points, exit. So rather than, sitting in trades and being hopeful that they're going to get a big swing, a lot of the smart traders are just looking to make a scalp and then get out of the market. 12 follow through for the bulls, but it's not really all that ideal. It's closing below your entry price if you had bought above 11, so that's really not what you want to see. But it is still a bull bar, and we are still always in long, so it's okay to be long. 13, more follow through for the bulls. You can see, I believe 13 is when we tested yesterday's low, or was it within one tick? No, sorry, we did not test yesterday's low on 13. But big tails, 12, 13. Again, we're still going here. We might pull back first, but it's not really all that likely. I think, we might get one more bar. Well, a lot of times when the market pulls back this much on bar 13, it's because traders are looking to get a better trader's equation. And so they'll buy the close of 14 for a scalp and just try and make basically 2-3 points and get us up to the magnet. That's exactly what happened. And then traders exited. 14 is not really a great buy the close bar because it's climactic. You can see the bull channel was not really all that awesome. It was a tight channel, so it's going to get a second leg up at some point, but it really just wasn't all that strong. So the breakout above on 14 isn't really a high probability breakout. Probably going to go more sideways here, and that's why we get a bear bar closing near its low on 15. It's a wedge, 1, 7, 14, and a possible high of the day on 15, which it did actually end up being the high of the day with your stop above 14. But I thought it was hard to take sell on 15 after 1, 2, 3, 4, 5, 6 bull bars. So I think you're going to have trouble taking a short like 15 after 6 bull bars. But it is a credible wedge. The target has been reached for the bulls. So a lot of them aren't really all that interested in staying in the trade. But if you're selling below 15, it's a minor reversal, and you're probably going to get 2 legs sideways to down. You're not going to get some big bear trend out of 15, most likely. Disappointing follow through on 16. We're probably getting back to the 14 close, but you knew that if you sold below 15. I think if you sell 15, you see 16, you probably just stay in the trade. It's kind of what you signed up for. Again, you're betting on a second leg sideways to down. You're not really sure how it's going to look, and 16 could qualify as your second leg sideways to down. It's important to note that when we traded above 16, so first off, 16 is a high one. It's not very good. You're buying high in what's probably now a trading range, and you're expecting the second leg sideways to down. So anyone who bought the close of 14 was disappointed in 15 and used the rally above 16 to get out during 17, which is exactly what we got right here. You can see we went one tick above it. 18, a second reversal up. Good for the bulls. It's a high 2, but I don't really want to buy here. You're buying on a relatively flat moving average at what is probably the top of a trading range. 18 is more of a swing trade if we trade above it. And I think bears who bought or who sold below 15 would probably exit above 18 because their goal was to get 2 legs sideways to down. And unfortunately, it was just not a profitable 2 legs sideways to down. 17 was considered the second leg. However, usually when you get a move like this on the open and then you start to go sideways, you probably go sideways for an hour or two. So I would hesitate buying above 18, thinking that we have not gone sideways for long enough yet. You get a disappointing bar on 19. So we were never even able to trigger above 18. I think mostly because bears are selling the market, trying not to let it go above 18. Not necessarily because they think it's going to turn into some huge rally, but they know that the rest of the bears are probably going to exit above 18 if it gets there. So it's better not to try and not let it trigger, and you have good risk reward taking that trade. So 19 bears, the bear argument, I suppose, would be getting a breakout below the high two, and you want some sort of measured move down. Bulls are hoping that it's some sort of wedge is going to be forming. Again, the measured move down is what we did end up reaching, the tight trading range from here to here. But I think that not really high probability selling below 19. But it's notable that bulls are having a lot of trouble at the moving average. And then if you look at 20, 20 did something really interesting. 20 is a bear bar closing near its low, but after this tight channel, the bears probably need one more really strong bar, and they're probably not going to get it. And if you look at where 20 closed, it closed right at the midpoint of the day. So what do a lot of traders do? Well, a lot of traders just buy the close of 20, which is why there's a micro gap up. They buy the close of 20 and they just put a stop down here, and they think that we're going to go up here. But if it's a big bear bar closing near its low, why do they think that we're going to go up here? Well, probably because the channel up was relatively tight. And so they know that the odds are against the bears just crashing. It's probably not going to happen. If you sell below this and you try to get down here, it's probably not going to happen. We're probably going to have to go sideways first. So the traders doing that are, would imagine they think they could at least make a scalp, if not a bit more. So it makes, it probably makes logical sense to buy the close of 20 more than sell the close of 20, since it's at the midpoint of the day. And odds are we're going to break out of the 18 bar range. And since there was a tight channel up to basically bar 14, we're probably going to get a second leg from that. So we're going to get closer to the high, probably before we go much lower. 21, it's bear follow through, but it's not really the follow through you want. I think if you sold below 19, you wanted to see a really, really strong bear bar. If you sold below 20, you wanted to see a bar that looked pretty much exactly like 20. And instead, you got 21, which was pretty much, it's a disappointing bar, if I'm being honest. I think if I sold, I would have wanted to see, a bar that looked exactly like 20. 22, a bull bar closing near its high. Do you buy above 22? I didn't mark it. You probably can. Betting the second leg up is going to start, but realistically, it's probably more of a scalp. And where are you scalping to? Well, it's a trading range day, pretty clearly. I do think we're getting back to the bar 18 high at some point today, and probably the bar 16 high as well. But we're probably getting back to the 18 low first. So if you buy above 22 and you see 23, you can't really buy above 23, I don't think. I think the edge is pretty much gone because the target is the 18 low. So they buy above here, and they probably end up exiting more so above 23 than they do buying above 23, because this is where the target is, the 18 and 19 low. And that's why you get a disappointing bear bar closing near its low, bar 24. Am I selling below 24? No, probably not. Bears want, trend line break and then lower high major trend reversal. I probably think we need to go more sideways first, and bar 23 is a pretty strong bar, so it's probably going to get its own second leg. We might go a little bit lower, but where are we going, right? Pretty much on these days, it makes sense to just look for areas where limit order traders might be trapped and just look for ways for them to get out. So I think that, or stop order traders, right? So you can bet on gaps closing for limit order traders, or us touching the closes of bars to let out stop order traders. So you can see on 25, we tested the close of 21, and then we got a bounce on 26. Why? Because the traders who sold the close of 21 were hoping to get a big crash down, and instead they were disappointed. They knew selling that they were probably going to be disappointed, so they probably scaled in, maybe at the 18, 19 low, or a couple points, just arbitrarily a couple points above where their initial entry price was, and they're using bar 25 to get out. They know that they're probably going to be let out if they use a wide stop and scale in, since it's trading range day. 26, a bull bar, put a big tail on the top. See, we tested the exact high of bar 24. And then 27, an inside bar for the bears. It's a double top. Are you selling? No, I think that it's a disappointing bar. I think we're probably going more sideways here. And then you get 28. You can see buyers below. Am I buying above 28? Bulls want some sort of double bottom. Essentially, they want 22 to be the start of the trend, 22, 23. And this is a breakout pullback, high 2 at 28, but not really that good since it's a bear bar. Good follow through on 29, but where are we now? We're right at the moving average, and I don't really want to buy this high. If you're buying above 29, it's a swing trade. I think that my biggest problem with 29 is the bear argument is relatively credible. The bears see 18 or 19, 20, 21 as the start of their bear trend, and they think that this was just a three-legged pullback. So 22, 23, 26, and 29 is 3 pushes up, and this is just a wedge pullback for them, and they're going to continue down. Do I think that they're going to get a huge bear trend out of this? No, probably not. But is it valid to think that they're going to get at least a little bit more to the downside? Yeah, it is. And considering how much trouble the bulls had at the moving average, buying right at the moving average might not be the greatest idea right now, considering the bear argument of the wedge. So, and then you get disappointing follow through on bar 30. If you bought above 29, you wanted at least minimum follow through, which would be a doji bar. You can see, or if you were watching over the last like 30 seconds, it was like bull bar and then doji, then bear bar, then bull bar, then doji. So traders were fighting over this tick a lot, because if it was any sort of bull close, that would make the bear argument less valid and make it more likely that we end up getting the bounce. And I thought bar 31 was really important. If you look in the first minute of bar 31, so this is a 1 minute chart. This is the first minute of bar 31. We sold off dramatically and then we went sideways. So why is the big question. In the first minute of bar 31, we were basically, the bar was on its low. Why? Because the bulls who bought the close of 29 were hoping 30 was any sort of bull bar. And instead, it ends up being a bear close. When they saw that 30 was a bear close, what do? They just exited the market. Disappointed, thinking now it's a trading range day, and they bought high, so they just want to get out, and that's what causes the big bear bar 31. Big tail on the bottom of 31 though, which is disappointing for the bull or for the bears. And it wasn't unreasonable to buy above 29. So the traders who do it and scale in are probably going to make money. So you know that the bar 29 high is a magnet, which is one of the problems with the argument that we're going lower here. 32 bull bar, but not really all that ideal. You bulls wanted a bit of a better close so that they could bet that the breakout to the downside is going to fail. But instead they got a small bar. Bears, they want 31 to be their breakout, and 32 is a breakout pullback, and 33 is the follow through for them. But, I'm not selling 33. I think if we're going to get a breakout to the downside, first off, we don't close below the 22 low. It's really important to close below breakout points, so we're not able to do that on bar 33. So not closing below the 22 low is pretty disappointing for the bears. And then once we don't close below the 33 low, you also have to keep in mind this could just be 2 legs down. 1, pullback, 2. If this is going to be such a strong breakout, why does bar 32 exist? It's really disappointing, and traders didn't want to see it. So this is really not all that excellent for the bears. They need to see another good follow-through bar for their argument to get to become more credible. And instead, we get a big outside up bar 34. So now we have the wedge, right? 1, 2, 3, and a failed breakout below and a reversal up. Bears are hoping this is all just a pullback, but it's not really all that great of an argument. Instead, you have a really strong bull bar closing near its high 34. It's a big bar, so the risk is relatively big, and you are buying right at the moving average. But what are the things that you know? Well, not with 100% certainty, but you can be relatively certain we're getting back to the bar 18 high, since this was a reasonable area to buy, and probably the bar 16 high, since this was generally a reasonable area to buy. So we're probably going to get a rally somewhere up to here, and we're definitely going to get at least to the bar 29 high. However, that's not very much higher above, and it is a really big bar with big risk. But it's an okay buy, I think, and you can argue this is going to be the start of the second leg up from this. So I think it's reasonable to buy 35, and you get follow through 36, tail on top, but still okay. But reminder that this is a trading range. Follow through 30. So sorry, I meant 35. Follow through 36, but tails on both sides. Again, not doing what you would want it to do if you think this is going to turn into a big bull trend. This is instead more of a leg in a trading range. Disappointment 35, tails on both sides 36, and then an inside bar high 137. So what do high ones usually lead to? Some sort of pullback before trend resumption. So, we're probably going at least a little bit higher here. I'd imagine we're going here or here, but then we're probably going to find sellers. You can see we found sellers 1 tick above the 16 high. And it was right around the area where bulls were able to make more than 5 points. They were able to pretty comfortably make 5 points. You can see it's kind of interesting. Right around the close of bar 38. So first off, high 1, inside bar 37, and we get a bull breakup 38. Traders exit, and then around the close of 38 is where bulls were able to make 5 points. And if they were long and hoping that 38 was going to break out to the upside, they were disappointed with the tail. And traders have been disappointed enough with the tails on 35, both the tails on 36, the tails on 37. So when they see the tail on 38, a lot of traders just exit, and that causes the bear bar closing somewhat near its low 39. Probably at least a second leg sideways stop. But the reason traders are exiting is because they can just exit with a 5-point scalp, and that's a reasonable thing to do. An inside bar 40, so you can see any trader who was willing to exit below 39 was never filled, and we rallied up towards the 38 close on bar 40 and ended up finding sellers there. 41, good for the bulls, but this needs to do more. These bars have such big tails on them, it makes me think we're going to be more sideways. But it's notable that we didn't break out of the high of the day. I'm thinking that we could be seeing a parabolic wedge, 32, 36, 42, or you could just say 36, 38, 42. Either is probably reasonable, or 30, 38, 40, 41. I meant to say 41 all this time instead of 42. But any of those is probably credible. And then you get an inside bar 42. But what is 42? It's a doji bar. It was a bear bar closing near its low, but instead we got a disappointing close in the doji bar, and it makes traders less willing to sell, and it makes it a magnet later in the day. So instead of selling for a wedge, a lot of traders get disappointed and decide not to take the trade. We do still get a follow-through bar on 43, but I still think that we're probably getting back to the 42 low at some point today because of how disappointing that the bar was, and it ended up being a doji bar. So the traders who scale in here will probably be rewarded. 44, bad follow-through for the traders who sold below 43. Bulls wanted a breakout, a really strong close on 44 and a breakout above the wedge, but didn't end up happening. 45, a bear bar closing near its low, an inside bar low 1, but it could just be a second leg down from bar 43. Traders who are selling a trade like 45 will be quick to exit if they are disappointed, and they are disappointed on 46, which most traders are expecting. So what do? 47, they just get out on 47. That causes the bounce on 47. And then we continue the rally on 48, but probably sellers at the 42 low if we get there. And you can see we never triggered 48. It's looking like some sort of triangle. You could argue 11, 34, 40, 46. And then possibly for the upside, 14, 42, and 48. Really, it's just higher lows and lower highs is what's important. And that seems to be what we're getting. So the range is contracting. So, do I want to be buying above 48? Probably not. You're probably going to be disappointed. If you want to sell below 49, I don't really. I think that 48 was really was really, really strong. So if you're selling below 49, you have to realize it's a trading range day, and we're probably going to get back to the 48 high. So it's hard to take a short like that. Bad follow through on 50. If you sold, you were hoping trader was going to get immediately trapped, and instead you got kind of a, it's follow through, but it's really not ideal. 51, you can see some traders used a limit order and sold the 49 low during 51. But again, to me, this looks like a couple legs down. And once you get 51, if you'll notice, you have a wedge, 39, 44, and 51. You can see. You could look at it as just 3 pushes down, 43, 45, 46, and then this. So you could look at it as 3 pushes down or a wedge. It's kind of the same. It's all the same forces. Just depends how you prefer to look at it. But bulls would see a rally and then a wedge pullback, and they want a second leg up. Bears see a, they see the wedge, but they want a strong breakout below to at least the 33 close. They think there are traders who sold the 33 close who are still trapped, and they should be able to get out. Additionally, even the 3 low was probably a magnet, and we tested it. So really no trader who took a reasonable trade and scaled in today lost money, which is pretty rare. Usually those traders are able to get out, but not usually to the extent like today, because usually eventually someone gets trapped. 52, a bull bar closing near its high. It was a wedge, like I said. We're probably getting back to the 48 low and the 42 low, but I kind of had problems with 52 because 3 straight bear bars. So I thought it was harder to buy the 52 after 3 straight bear bars. But if you did take the buy, you can see those traders were pretty easily able to make the target, which is 5 points. I would imagine just everyone's trying to make 5 points on this day. Where is exactly 5 points? So no exact clear targets for 5 points, but those traders were able to make 5. And you can see 53, really big bull bar closing somewhat near its high, but top of the trading range and big bar, big risk. So when it's top of the trading range, big bar, big risk, in this context, this looks like more of a profit-taking bar, which is exactly what happens on 54. 55, buyers below 54, you can see. So probably not going much higher. It's a disappointing bar on 55. You wanted to see a big bull bar closing near its high if the bulls were going to get the bull trend. Instead, you get disappointment. 56, buyers below 55, but again, consecutive dojis. This just looks like the top of the trading range to me. If you had bought, the high of 53, you wanted to see a really good follow-through bar on 54. Instead, you get 54 and then consecutive dojis, so not great. 57, a bear bar, but a big tail on the bottom. 58, follow through for the Bears, but not really all that great. Big tail right on a right on the moving average. 59, high two. I can understand the logic for buying 59 because 52, 53 really strong, should get another, a bigger leg up than just 56, 55, 56, but lower probability trade for sure. And you're buying towards the middle of the trading range, but you are buying a reversal up from the moving average, which is good for the Bulls. But I can kind of understand the logic for buying with 59. I didn't think it was the worst thing in the world, but you did end up getting trapped on this one. And a lot of traders would prefer to sell below 60, a bear bar closing near its low. The problem with 60 is it could be a wedge, 54, 56, 59, but you're getting a breakout below 54, 56, 59. So you might be getting, you could argue it's just three pushes, 54, 57, 58, and then 60. But I think the more credible way to look at it is wedge, 54, 56, 59, and you're getting a breakout below. What's the problem with that? Well, the good thing the traders have going for them is we should get to here, right? We should get back to this low. But the problem is every limit order bull today has been able to scale in and make money. So we're probably getting back up here at some point. And I think this bar 63, first off, it's a buy climax 52, 53. So there are always going to be buyers at the bottom of a buy climax. So that's the one problem with being short down here. You can see the follow through on 61, not that ideal, big tail. So reminder that we're still in a trading range. 62, again, problems. A lot of traders more looking to exit. And that's exactly what happens on 63, and you get such a big rally. But again, 63, I think, was just trying to test the 59 high to let those limit order bulls out. A lot of them, if they bought and scaled in, are so disappointed in this, they'll take a small loss in their first entry, and that's why we pulled back 63. But others will hold, knowing we're probably going to end up getting back up here. 64, it's a second leg down for the Bears from this, and you're towards the bottom of a trading range. I think the 33 low was probably the target for those Bears. So it could be 1, 2, 3, 1, 2, 3, some sort of wedge. Expect two legs sideways to up. 65, probably okay to buy above 65. But if I'm buying above 65, I would use a stop that's a measured move down and look to buy more below 65 rather than exit, because traders with wide stops are the ones making money today. So if that's what's happening, you should also be trying to trade that way. 66, disappointing follow through, but relatively expected with the tight channel down. You should get a second leg sideways to up. 67 could be that second leg sideways to up. Looks like a tight trading range towards the bottom of a trading range. But I don't think I'm selling below 67. It's, Bears see a low one short, but really not all that good. 68, follow through, quote unquote follow through for the Bears, but this is just tight trading range to me. Tight trading range at the bottom of an overall trading range. You see we found buyers below the low, so that's why it's silly to buy here and put a stop here, because this is going to happen a reasonable portion of the time. So if you're buying 65, you're expecting bad follow through. You're hoping we just get a quick bounce and you make quick money, but that's pretty unlikely on trading range days. So you probably buy here, you put a stop somewhere down here, and you add on below, and you get a reversal up 69. Do you buy above 69? It's right on the moving average. It's probably fine, but it's an outside pattern, right? So 67, outside bar 68, outside bar 69. It's probably reasonable, but just big bar, big risk on a trading range day. Some magnets above, but kind of difficult. I would say, just on the basis of an OO pattern, 60% chance you get something to the upside, but not really sure what. And again, those traders able to make a 5-point scalp pretty easily, a little bit more. So I suppose the 5-point scalp wasn't the target for everybody, but I think that a lot of these trades today, the first couple were 5-point scalps. Buying above 11 was a 5-point scalp. Buying above 34 was a 5-point scalp. So, for most traders, that would probably switch you into scalping mode, and you would just be scalping 5 points for the remainder of the day. Disappointing follow through on 70, so a doji bar, but still follow through for the bulls, so not the worst. And then, but again, it's a trading range day, right? So you're going to get this kind of stuff. Then a big bull bar closing near its high 71, but why is there a pause bar that's a doji on 69? This is going to be a huge bull trend. Not really that great, and you get a rally on 72, but a lot of traders are going to exit. Am I selling below 72? Probably not. You can see that we're probably just at the top or towards the middle of a trading range. So, you can probably buy below 72, but expecting some sort of second leg up, but you're towards the high. So it's really not all that great. 74 looks like a third leg up, 1, 2, 3. So not really all that ideal either. And then 75 closing near its low. I'm not really doing anything. 76, a bear bar closing near its low. Maybe, but aggressive right at this time of the day. So I would personally just let it go. You can see we went back to this low. Reasonable trades today. I think buying above 11 was okay, trying to get to here or maybe for 5 points. You could probably sell below 15, but I would not after all of this. Maybe 22, but I think if you bought above 22, you were sensing edge, and the edge you got was bar 23, and that you thought bears were going to exit above 22, and we would get back to the 18 low, and we did that pretty much on bar 23. So if you bought here, this is kind of what you were expecting, but you need to not hope that we're going to continue to rally. You probably just need to exit. 34, goodbye for probably 5 points, but when it gets disappointing like this, a lot of traders just exit. I wouldn't sell 49 personally. A lot of traders might, but I wouldn't, just because of how strong 48 was. 52. I'm not going to say I didn't take it. I didn't like it because of the 3 straight bear bars. It's probably good for you if you took it today, but probably better to scalp out somewhere up here than to continue to buy. I don't know. I can understand the logic for 59, but hard to do in this area when we haven't had a breakout yet all day, and you're betting on a breakout. So that's the problem. 60 outside down, wedge, breakout below. Probably an okay swing sell, but buy climax here. So a lot of problems with every trade today. And you can see you got the second leg down. Probably okay to buy 65 with a wide stop, probably 69. And yeah. And just pretty much for limit orders today, it was just everything was just scale in. Traders were scaling in relentlessly, betting against the breakout, and we never really ended up getting it. So this is one of those days where limit order traders make money all day. On the daily chart, this is not really all that great for the bears. No one's going to really want to sell below this. It's a small bar. We did overlap with this, but in reality, I think probably buyers below here. If we trade below here, buyers below here, and we'll probably get some sort of reversal up from the moving average. Now, is this reversal up from the moving average going to lead to a bull trend? Probably not. I think that this is a final flag for the bulls, but we might have to stay within the tight trading range for a little bit. There's definitely a chance. I don't know, maybe 30. I'm not quite sure it's 40, but maybe 30% chance that we just get a huge bear, maybe 40% chance that we just get a really big bear bar tomorrow. But I just don't think it's very likely. I think something disappointing. If you're selling below here, you're going to get stopped out just like every time. So that's kind of my thought process there. On the weekly chart, looks like some sort of 3-bar reversal forming. It would be better for the bears if this stayed an inside bar. They don't want it. They want to keep the bar smaller in an inside bar, so it's more of a triangle on a lower time frame. And then they can get, if it trades below, some traders will sell, betting this was just a buy climax, and we might have to test down to the low of the sell climax. But we might just end up closing gaps. If you sell below, if this closes, let's say this closed today and you sold below it, it's going to go more sideways to down, and you're probably going to get another leg up before you get down here. But we probably are getting back to 5,000 in this close at some point. On the monthly chart, pretty good for the bears to put that tail on the top. We'll see if they can continue to do it. The midpoint of the month is probably pretty far out of reach, 100-ish points. So the bears would need to do a lot. So this is one of those months where it's just the bears trying to put as big of a tail as possible, and the bulls are trying to make the rally as strong as possible. That's the day.